Okay, so picture this, a U.S. semiconductor company, but it's not just another factory pumping out chips. This one partners with tech innovators, almost like a co-creation lab, right?
Yeah.
It's a really fascinating model, and that's exactly what we're diving into today.
Okay.
SkyWater Technology trades on the NASDAQ under the ticker SKYT, and the goal of this deep dive is pretty simple, really. We want to extract all the key insights from a pretty detailed research plan to help you understand if this company you know is worth investing in. So consider this your shortcut to really understanding what makes SkyWater tick. What's their approach? Who are the leaders? How's their financial health? What's the future look like? And speaking of unique discoveries, we actually uncovered something really interesting about SkyWater that we'll reveal towards the end. So stay tuned for that.
I like that.
Yeah, so let's jump right in and unpack the SkyWater story.
All right. So what really stands out to me right off the bat is their technology as a service model, TaaS for short. It's kind of a hybrid approach. You can think of it in two main parts. First, you have their Advanced Technology Services, or ATS. This is where the collaboration really comes in. They work side by side with their customers on everything you know, from developing new semiconductor processes to getting the manufacturing tools up and running. They even give customers access to their facilities for this cutting-edge development work. Then the second part is their wafer services. This is more like your traditional foundry, where they manufacture integrated circuits based on customer designs. This two-pronged approach really allows them to capture value throughout the entire innovation cycle.
So it's not just about taking orders and churning out chips. They're actually involved from the very beginning, almost like an R&D partner who can also manufacture.
Exactly.
It's a pretty interesting twist. How does this translate into revenue streams for them?
Well, they basically have three main ways they generate income. First is through those ATS engagements, those fees they get for the collaborative development work. Then, of course, there's the revenue from wafer services, the actual production of those chips. But the third one is where things get really interesting.
Okay.
Their tool segment. They actually buy and sell semiconductor manufacturing equipment to their customers.
Interesting.
But here's the catch. This equipment usually stays within SkyWater's own facilities and is used for those very same ATS customer programs. So it's this really integrated model where they're not just selling off assets, they're building these long-term partnerships.
So they're equipping their customers, but not setting them off on their own. They're keeping everything in-house in a way to maintain that close relationship.
Right.
That sounds like a really good way to strengthen those customer ties. The research also mentioned something about customer-funded capital expenditure in their tools segment. Can you tell me more about that?
Yeah, this is actually a really important part of their financial strategy. It's a pretty clever way to manage risk, I think. So instead of SkyWater making these huge capital investments based on future demand, they rely on their customers to finance the purchase of that manufacturing equipment in the tools segment. So those investments are directly tied to specific customer projects and their needs.
Oh, okay, I see.
Which significantly reduces SkyWater's financial risk because they're not carrying as much speculative investment on their books. It also creates a shared risk and reward environment with their partners, which strengthens those collaborations.
Right. So it's a win-win for both SkyWater and their customers. That sounds like it gives SkyWater a layer of financial resilience. Let's see how this model has been working out for them by looking at their recent financial performance. What can you tell us about the numbers?
Well, the recent financials show us a story of both growth and some challenges. For the fourth quarter of 2024, their revenue decreased by 5% year over year, ending up at $75.5 million. But when we look at the entire fiscal year of 2024, they actually achieved a record annual revenue of $342.3 million. So that's a 19% increase from the previous year. So overall, a strong year with a bit of a slowdown towards the end.
So it's like two different periods then. What were the key drivers behind that dip in Q4?
When we take a closer look at the segment performance, we see a significant decrease in wafer services revenue in Q4 2024. It dropped by a pretty substantial 64% compared to the same period the year before. But what's interesting is that their ATS development revenue actually increased by 4% in that same quarter.
Okay.
So this could mean that there are more projects in the development pipeline that haven't moved into large-scale manufacturing yet, or maybe it indicates some variability in their traditional foundry business. It's something to keep an eye on for sure.
Yeah. So the development side seems to be doing all right, but the manufacturing volume took a hit in that particular quarter. Now let's switch gears and talk about the technologies they're working with and the markets they serve. What's their main technological focus?
They actually have a pretty diverse and specialized set of technology platforms.
Okay.
They work with mixed signal CMOS, which is fundamental for integrating both analog and digital functions on a single chip. Think smartphones, for example.
Uh-huh.
They also have rad-hard technologies, which are designed to withstand really harsh radiation environments. These are crucial for aerospace and defense applications.
Right.
And then there's MEMS, which is used to create these tiny mechanical and electromechanical systems used in sensors and actuators. Then they even have some really advanced stuff like superconducting technologies, which are used in quantum computing photonics for high-speed optical data transmission, and heterogeneous integration, which basically means combining different types of chips into a single package for better performance. It's a really broad portfolio that's geared towards demanding applications.
That's an impressive range of capabilities. So who are their main customers for these technologies?
Well, their specialized capabilities align really well with some high-growth and demanding markets. We're
Cool.
talking about aerospace and defense, where reliability and radiation hardening are essential, automotive with all the increasing silicon content in electric and self-driving cars, biomedical for those specialized sensors and devices, industrial applications that require robust and custom solutions. And of course, there's the exciting field of quantum computing, where their superconducting technology could be a real game changer.
So they've strategically positioned themselves in sectors with a lot of potential for long-term growth. The research also mentions something called ThermaView solutions. What is that exactly?
So ThermaView Solutions is a more recent platform that's focused on their thermal imaging ROICs and microbolometer solutions.
Okay.
Basically, they're targeting the growing demand for advanced infrared sensing, which is used in a lot of different areas, like in defense for surveillance, industrial safety for detecting heat signatures, and even medical diagnostics for measuring temperature without contact.
Interesting. So they're carving out these specialized niches within the broader semiconductor landscape. That sounds like a smart move. Now, when we look at their overall position in the industry, the research plan points out that they're the only U.S.-owned and operated pure-play trusted foundry with DMEA Category 1A accreditation from the DoD. That's pretty specific and significant, don't you think?
Oh, it's incredibly significant.
Right.
Being the only U.S.-owned and operated pure-play trusted foundry with that particular accreditation gives them a huge competitive advantage, especially when it comes to the aerospace and defense sector.
Right.
In that industry, the security of the supply chain and sourcing domestically are non-negotiable requirements. They're often mandated by government regulations. And this accreditation isn't easy to obtain or maintain, which makes it a big barrier to entry for any potential competitors.
I see.
So this basically makes them a preferred, and in some cases, the only viable option for a lot of critical defense-related semiconductor manufacturing.
So it's not just an advantage. It's an essential position to hold in a really important market. What about their size and manufacturing footprint?
As of right now, their market capitalization is about $393.1 million. So they're not quite on the scale of those industry giants, but their specialization allows them to be a key player in those targeted niches.
Right.
Their primary manufacturing facility is in Bloomington, Minnesota, and they just announced a pretty major acquisition, a 200-millimeter fabrication facility in Austin, Texas from Infineon Technologies.
Wow.
This acquisition is going to almost double their workforce, which is currently around 590 employees. It'll also substantially increase their production capacity, giving them a wider reach and the ability to serve even more customers.
That sounds like a big step in scaling their operations. Now, taking a step back, what's the overall outlook for the semiconductor foundry market as a whole?
The long-term prospects look very promising. Projections show a strong growth in the coming years, driven by major technological advancements, like the growth of artificial intelligence, for example, the increasing need for semiconductors in the automotive industry with electric vehicles and advanced driver assistance systems, the continued expansion of the Internet of Things, and the ongoing rollout of 5G networks.
Right.
It's a multi-billion-dollar market with some serious growth potential.
A lot of tailwinds for the industry then. Who are the main competitors they're up against?
The competitive landscape is dominated by those big industry players like TSMC and Samsung. They control most of the market share. SkyWater's strategy isn't to go head-to-head with these giants. Instead, they're focusing on those niche markets where they have a clear advantage with their specialized technologies and that crucial domestic sourcing angle, especially with their trusted foundry status. It's more about differentiation than direct competition.
It's about finding your strengths and using them strategically. That makes a lot of sense.
Huh.
The research also mentioned the CHAPS and Science Act in the U.S. How will that impact SkyWater?
Well, the GPS and Science Act is a big deal. It's designed to encourage domestic semiconductor manufacturing and research by offering substantial funding and tax credits.
Right.
So for a U.S.-based company like SkyWater, especially one with that trusted foundry accreditation, this act could be a real game changer. They have the opportunity to access grants and other financial support to help them expand, modernize their facilities, and further solidify their place in the U.S. semiconductor industry.
So the government is actively trying to support companies like SkyWater. How difficult is it to enter the semiconductor foundry business? Are there a lot of obstacles?
Oh, absolutely. The semiconductor foundry industry is known for having very high barriers to entry. First of all, it requires massive amounts of capital investment to build and equip these state-of-the-art fabrication facilities. Then you need that deep and specialized technological knowledge to manage these really complex manufacturing processes. And on top of that, you have to establish strong, long-term relationships with customers who depend on consistent quality and supply. These are all major hurdles that protect existing players like SkyWater and make it extremely challenging for new competitors to enter the market and compete effectively, especially in those specialized niches.
So those barriers act as a kind of protective moat for SkyWater. We've already talked about their unique accreditation and their customer-funded CapEx model.
Right.
What other competitive advantages do they have?
Well, besides those key factors, their technology as a service model has the potential to create a strong network effect.
Yeah.
As they partner with more innovative companies on early stage development, they gain valuable insights and a portfolio of cutting-edge technologies, which in turn makes their platform even more attractive to other innovators.
Right.
Plus, customers who are deeply integrated with SkyWater's specialized processes face significant costs and disruptions if they switch to a different foundry. So there's a lot of customer stickiness there. Their expertise in specialized technologies like radiation-hardened and superconducting integrated circuits, their expansion into advanced packaging in Florida, their own proprietary IP and process know-how, and now the added capacity from the Austin fab all contribute to a pretty strong competitive advantage.
It sounds like they have a lot going for them. Okay, let's shift gears and talk about the people leading SkyWater. What can you tell us about their management team?
The CEO is Thomas Sonderman. He's been in that role since October 2017. He was instrumental in taking SkyWater public back in April 2021, and his focus has been on diversifying their customer base and improving their operational efficiency. He has a pretty impressive background with a lot of experience at companies like Rudolph Technologies, Global Foundries, and AMD. He was actually involved in the spin-off that created Global Foundries. His track record shows a real emphasis on growth and establishing those strategic partnerships, especially with government entities. And the recent financial performance with those record revenue quarters and positive non-GAAP earnings shows that they're making progress under his leadership.
He seems to have a wealth of experience and strategic vision for growth. Who else is on the core leadership team?
They also have John Sakamoto. He joined as president and COO in September 2023. He's in charge of the company's business and manufacturing operations with a focus on profitability and sustainable growth. And then there's Steve Manko, the CFO. He's responsible for the financial strategy and driving shareholder value. So it's a good mix of seasoned industry veterans and fresh perspectives.
That's a good balance.
Yeah.
How has the management team handled challenges and seized opportunities in the past? Like, for example, securing those government contracts and funding.
Well, the research doesn't give us too many specific details about their responses to past crises, but their history shows that they've been able to navigate the complexities of the semiconductor industry, including things like supply chain disruptions and market fluctuations.
Right.
They've secured some big government contracts, like that substantial DoD contract in 2019, and they've been actively pursuing CHIS Act funding opportunities. So this suggests that they have a leadership team that's good at identifying and taking advantage of strategic opportunities while also managing potential risks through government partnerships.
It's good to see that proactive approach to government initiatives.
Yeah.
What about communication and transparency with their investors?
They have a pretty active investor relations program. They have regular earnings calls, investor presentations, and a really detailed investor relations website. This consistent communication shows that they're committed to transparency and keeping their shareholders informed about the company's strategy, performance, and future plans.
Makes sense.
They also have publicly available codes of conduct for their business operations and their suppliers, which indicates a commitment to ethical business practices.
Those are all positive signs. Now let's look at how they're allocating capital to drive growth. Where are they making those big investments?
They've been making strategic investments in a few key areas. They've been upgrading their main facility in Bloomington, Minnesota to increase production capacity by about 30% and modernize it to better serve those high-growth markets like aerospace and defense biomedical and quantum computing.
Okay.
These upgrades are being funded through a combination of their own capital and a significant amount of customer-funded capital expenditure, which is projected to be over $350 million through 2026. And of course, there's that potential Cheese Act funding of up to $16 million, which will also help with these efforts.
So customer-funded CapEx is still a key part of their growth strategy. And of course, there's that big acquisition of the Infineon fab in Austin.
Right. That acquisition was a major capital allocation decision. Buying that established 200-millimeter fabrication facility is a strategic move that will significantly expand their U.S.-based manufacturing capacity and broaden their technology offerings, particularly for the industrial, automotive, and defense sectors. The deal also includes a long-term supply agreement with Infineon, which will ensure that the fab is being utilized. This acquisition is expected to create economies of scale and allow SkyWater to offer more comprehensive services to a wider range of customers.
It seems like a well-planned acquisition designed to boost their scale and technological capabilities.
Right.
What about returning capital to shareholders? Are they currently paying dividends or buying back shares?
As of now, they don't have a history of share buyback programs, and they're not paying any cash dividends on their common stock. This means that their focus is on reinvesting those earnings back into the business to fund growth initiatives, like the upgrades to their Minnesota facility and the acquisition of the Austin fab. They're prioritizing expansion over returning capital directly to shareholders at this point.
So their focus is on growth. Now let's look at how efficiently they're using their invested capital. The research plan mentions their return on invested capital, or ROIC. What's the story there?
So ROIC basically tells us how effectively a company is generating profit from the capital it's invested in its operations. In 2023, SkyWater's ROIC was around 15.55%.
Okay.
But based on the 2024 financial data, our estimate shows a decrease to about 10.54%.
Oh.
So this dip from the previous year is something that investors should keep an eye on to understand what's causing it and if it's just a temporary blip or a sign of a bigger trend.
It's definitely a metric to watch.
Yeah.
Now let's take a deep dive into their overall financial health by looking at some key metrics. What are the main highlights?
As of early March 2025, their market cap was about $393.1 million. Their price-to-earnings ratio isn't really meaningful right now because of their negative trailing 12-month earnings, even though they did report positive non-GAAP net income for the full year 2024. Their revenue grew by a solid 19% for fiscal year 2024, but then dropped by 5% year over year in Q4 2024. Their GAAP gross profit margin for fiscal year 2024 was 20.3%, and it actually improved to 25.6% in Q4 2024.
Interesting.
Their debt-to-equity ratio at the end of 2024 was 0.953. For the whole year of 2024, they reported negative free cash flow of $3 million, and their price-to-book ratio was about 6.37 as of early March.
So it's a mix of some strong top-line growth for the year, offset by a decline in the last quarter and that negative free cash flow. What about their financial stability and liquidity?
Well, their earnings history over the past 5 to 10 years shows some ups and downs. Their revenue has generally been trending upwards, but their profitability has fluctuated. They're not paying any dividends at the moment.
Right.
They did recently amend their loan and security agreement, which increased their borrowing capacity to potentially $160 million and extended the maturity to December 2028. This gives them more financial flexibility, but their working capital efficiency, which we can see from their current ratio being less than 1 at the end of 2024, suggests that their short-term liabilities are greater than their short-term assets.
Okay.
So this could point to potential liquidity challenges in the near term, although that increased borrowing capacity could help mitigate that risk.
Some things to watch out for then. Now let's talk about how the market views SkyWater. What's the general sentiment surrounding the company?
It seems like market perception is a bit mixed. You can see that in how much their stock price has fluctuated over the past year. It's been trading in a pretty wide range.
Right.
Recent trading activity has been influenced by their earnings announcements and the news of that Infineon fab acquisition. It looks like there's some optimism, especially after those positive earnings reports, but the volatility in the stock suggests that investors are still unsure about their future performance and how they'll integrate that acquisition.
That makes sense given the recent ups and downs and how big that acquisition is. What about the ownership structure of the company? Who are the main stakeholders?
SkyWater has a large amount of institutional ownership. Institutions hold about 70% of the outstanding shares, and insider ownership is significant too at around 42.55%.
Okay.
It's worth noting that in the past 3 months, there's been more insider selling than buying. Insiders have sold about $71,944 worth of shares. So investors might want to look into the implications of that concentrated ownership and the recent insider selling.
That level of institutional and insider ownership could mean that they're aligned with long-term value creation. But those insider sales do raise some questions. To sum up our analysis, let's do a SWOT analysis to understand SkyWater's strengths, weaknesses, opportunities, and threats. Starting with their strengths, what do they have going for them?
They have several key strengths. Their technology as a service model is unique, and their DMEA Trusted Foundry accreditation is extremely valuable. They have a specialized technology portfolio that caters to some attractive niche markets. They also have strong relationships with the U.S. government, and the potential benefits from the TIC Act are significant. Then there's the strategic acquisition of the Infineon Austin fab, which will significantly boost their capacity and reach. And finally, their customer-funded capital expenditure model gives them a distinct cost advantage.
That's a lot of strengths. What about weaknesses? What do they need to improve?
Some of their main weaknesses are the recent decline in their wafer services revenue, their history of fluctuating earnings, the fact that their free cash flow was negative in the last fiscal year, and their low current ratio, which could mean potential short-term liquidity problems.
Those are some important challenges to address. What opportunities do they have for future growth?
They have a lot of potential opportunities. The demand in their specialized niche markets is growing, particularly in aerospace and defense and quantum computing. The U.S. SHIP-PS Act could provide a lot of financial support. Their move into advanced packaging could bring in new revenue. And if their ATS segment continues to be successful, it could drive more growth in their wafer services as those technologies they develop move into volume production.
So there's definitely room for growth. What are the biggest threats they face?
They're operating in a very competitive semiconductor foundry market, and that's a big threat. Some of their key end markets, like automotive and industrial, are cyclical, which means demand can fluctuate. The integration of the Austin fab comes with operational and financial risks, and because they rely on customer funding, they're vulnerable to economic downturns that could impact their customers' investment plans. Then there's the rapid pace of technological change in the semiconductor industry, which means they need to keep investing and adapting.
It's a dynamic and challenging landscape. To wrap things up, what are your final thoughts on SkyWater's investment potential based on everything we've discussed?
It's a really interesting but complex case. Their business model is unique, and their position as the only U.S.-owned and operated pure-play trusted foundry with that specific DMEA accreditation gives them some big advantages, especially in those critical sectors. The SHIP-PS Act and the Austin fab acquisition could be major catalysts for growth. But investors really need to look closely at their recent revenue trends, their cash flow, and the risks that come with that acquisition. It's really important to understand their specialized business model and keep track of their financial performance.
Now, for the interesting fact we mentioned at the beginning, as we've seen throughout this deep dive, SkyWater Technology holds a truly unique position. They're the only U.S.-owned and operated pure-play trusted foundry with that specific DMEA Category 1A accreditation from the Department of Defense. And that really sets them apart, especially in such a sensitive and strategically important sector for the United States.
Absolutely. It highlights just how different and valuable they are, especially now that there's so much global focus on the security and resilience of domestic semiconductor supply chains.
So as we wrap up our deep dive into SkyWater Technology, it's clear that they occupy a really interesting and strategically important place in the U.S. semiconductor industry.
And this raises a really important question for you to think about. Given all the geopolitical emphasis on domestic semiconductor manufacturing and SkyWater's unique and critical role, how might future government policies or unexpected global events affect their growth and investment potential? It's definitely worth considering.
You can find links to all the research we used in the description below. And remember, any stock suggestions you might see in the comments are just that, suggestions, not financial advice. Do your own research and talk to a financial advisor before making any investment decisions. And keep in mind that we've made some forward-looking statements based on the information we have now, but actual results could be different. This is our analysis as of today, and it shouldn't be taken as a recommendation to buy or sell any particular stock. This deep dive was done with the help of AI to analyze the research plan. If you found this informative and you want to stay updated on our in-depth analyses, subscribe to the Stock Analytics AI YouTube channel.
Thanks for listening.
Thanks for joining us.
All right.
See you next time.
See ya. Bye.